Welcome to Econ Talk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is February 9th, 2011, and my guest is Daron Acemoglu, the Elizabeth and James Killian Professor of Economics at MIT. Daron, welcome back to Econ Talk.
Thanks very much for having me back, Russ.
Now, you recently made a presentation on the financial crisis and the role of inequality. And inequality is often invoked as a potential explanation for various crises. I think sometimes the evidence for that's a little bit weak. But you were criticizing some of that work, particularly you're criticizing or at least providing an alternative to an argument put forward by Rajan in his book Fault Lines. What is Rajan's argument and your alternative?
Well, let me first start by saying that I think Rajan is one of the most creative and accomplished economists of his generation, and somebody I always learn a lot from, and he always comes up with interesting ideas, and this is no exception. And I think he has actually come up with a very rich analysis of the financial crisis and its implications and causes in his book Fault Lines. And one of the ideas or one of the lines of argument in that book has attracted a lot of attention, and it is a very creative and interesting argument that some other people have also kind of supported or expressed in somewhat different forms. And I think it's to me, it sounded like an intriguing hypothesis, and it made me think of related ideas, and sort of also why perhaps I am not fully convinced by this idea. And I guess this is what I've tried to argue in a presentation in the American Economic Association in Denver last month, and so let me start with Rajan's hypothesis. I think it's essentially Rajan takes off from a well-established literature in labor economics, which relates aspects or parts of the increase in inequality in the labor market, which has risen quite considerably over the last 30 years, to technological developments, in particular things such as information technology, robotics, new organizational forms that have increased the demand for more abstract skills, more skilled workers, and the general consensus is that this, combined with perhaps slower increase in the supply of skills in the last 20 years or so than the U.S. had experienced before, led to a relatively sharp increase in the college premium, and also a relatively sharp increase in the overall inequality in the labor market. For example, measured by such things as the gap between those who are at the 90th percentile of the earnings distributions, those, the richest top 10, so to speak, versus the bottom 10 percentile, the bottom 10%. And that gap has increased a lot, or if you kind of look at other measures such as, Gini coefficient or standard deviation of wages or earnings or family incomes, they have similarly increase. There is a debate in labor economics whether, what's the role of technology, what's the role of trade, and so on. But most economists are sort of comfortable in thinking that, technology has played a leading role here. Trade has probably played quite a major role too, but intermediated by technology, so that, it's not the kind of the trade in goods of the 1980s and so on, but it's the kind of offshoring and outsourcing of jobs that has been intermediated by, again, information technology of the late 1990s and 2000s that's probably played a role. And then there is a debate about what's the role of institutional factors such as, the demise of unions and the minimum wage and so on, and that's still not entirely settled. But but taking this consensus as given, there is this largely exogenous increase in inequality, goes the argument, but this exogenous increase in inequality or technology-driven increase in inequality has created tensions in the political system because part of the U.S. population is seeing its income rise rapidly, another part is stagnating or not seeing the same kind of gains. And there has been an increased pressure on the political system to do something about this problem. So to appease the bottom of the distribution that's not gaining from this increase. Now, in different versions of the argument I've seen articulated, it's sometimes about appeasing the bottom, but you could also equally tell the story about, say, appeasing the middle. So if you look at what's going on to the top of the income distribution, 90th percentile, and say the middle, the median earner in the United States, that's also increasing. So you could tell a story that inequality is increasing, and the middle guys are feeling unhappy because they're not seeing the same gains, to the same extent of gains as the top guys in the 90th percentile, and that's why the political system had to respond. And the political system in Raghu's story responds in the cheapest possible way, and perhaps there might be other reasons why it responds in this way, but it essentially encourages government-sponsored enterprises, the likes of Fannie and Freddie, to provide cheap credit to the bottom of the income distribution, or perhaps to the middle classes who wouldn't have otherwise been able to afford houses at subsidized and perhaps over-subsidized rates. And this political response then lays the groundwork for the financial crisis, where there's a housing boom because too many people who were at the bottom and who didn't really have the purchasing power to really buy houses are buying houses, and then you have the housing bubble, and then the housing bubble is the source of what's going on. And when the housing bubble crashes, everything comes tumbling down. So that's kind of in a nutshell is one part of Rajans' thesis.
Now, last week we had on Tyler Cowen talking about the Great Stagnation, and I expressed some skepticism about the median income numbers, but whether those are right or not, it's certainly true that measured inequality has grown. If you compare, say, 90th or 95th or 99th percentile to the 50th. Of course, I've always wondered how much people are aware of that if they don't read the New York Times. As a generator of political demand, maybe it's a supply argument that has to be made, but as a demand factor, I don't really think that the average person sits around thinking that there's all these other people doing much better. I mean, our access to that, the tangibility of it's very weak, it seems to me. So I've never been persuaded by that as a.
Well, that's a good question. I don't really know. I mean, I think people do draw relative comparisons, and we have a very globalized media market, so it's hard to imagine that people living in the inner city Detroit or Nevada don't really know that there are parts of the country where incomes are increasing and people are living much more comfortably. People in Nevada probably know that the richer neighborhoods in California are prospering and so on. But I would that's just a guess. I wouldn't know for sure. But it's if you think about it, right, following the financial crisis, for example, I mean, a lot of people have been very acutely aware that the burden of the crisis has not been equally borne, and both on the left and the right, there is a lot of talk of the bankers are not having their pays; they're still having very very high salaries,
no
and
doubt
their
about
bonuses
that,
and so on and so forth.
No doubt about that. And I think people are very aware of it. It's actually, if anything, it's fascinating me how little politicians of a populist stripe have exploited that or tried to.
Right.
It's fascinating. I have a sinister theory of that, which we may get to later when we talk about the banking and financial sector. But let's go on. So that's Rajan's idea, and you're going to give me an alternative as well as an argument that the data better explain your idea. So go ahead with that.
Right. Yeah. So I guess the alternative that I would put on the table, and I think other people have sort of suggested similar things. So I would definitely not claim, sole authorship of this at all. But is that, if you think of the Rajan story, is that politics is just a response. It's just an intervening channel. Whereas, for understanding the financial crisis, it might be that politics was much more of a driving force. That it might actually have been that it was politics acting as sort of an autonomous force, and I'll try to explain what I mean by that in a second, really shaped the state of finance and the financial industry in the United States, especially over the last 25 years or so. And developments in the financial industry then caused both the financial crisis and also, through related processes, part of the inequality that we observe in the United States. And here I should just take a moment to explain what I mean by that, is that I think there is a difference between what I'm going to call labor market inequality, which is what I think Rajan is talking about, and top inequality. And by top inequality, I mean how much do the people in the very, very, very top of the income distribution in the United States earn relative to the rest of the population. So, for instance, the people who are the top 1% or top 0.1% of the U.S. population, the really very, very highly paid CEOs, many of whom I'll say in a second in more detail, happen to be in the financial industry, but of course there are also some in the entertainment industry and so on. But
it's a pretty that top. Obviously it depends how you define it. The top 1 or 0.1%, whatever you call the upper crust there, it's a pretty diverse group of business executives, lawyers,
right,
surgeons, basketball players,
right,
entrepreneurs.
Right.
Those would be I would think the big groups. And of course some of those there are not very many people in them, and some there's not very many people in any of those by definition, because they're at the very top.
There are not many people, but finance has become much more overrepresented in that tranche than it had been before. And we'll talk a little bit about some work that other economists have done, which kind of provides some evidence consistent with that. But the top inequality. So the reason why I'm drawing this distinction between, say, labor market inequality and top inequality is that I think we have there is no consensus, as I just expressed, but there's a fairly detailed work on what causes labor market inequality, what causes the difference between, say, college graduates and high school dropouts, between postgraduates, people with MBAs, the regular MBA folks, and people with just a college degree, or the 90th percentile relative to the 10th percentile. There is much less work about what's going on what are the causes of the explosion in inequality at the very top of the distribution, and for good reason.
There's a little bit. The superstar literature is
there is, but not empirical. I mean, so there's a very good reason for that, which is that the usual data sources that people use for this, like long-term inequality trends, the current population survey or census data, they're all top-coded, which means that they tell you accurately what's going on at the 90th percentile, but not much more above that, because there's a certain level above which your income is not revealed in those data sources.
Meaning it's 100,000 or more. But you don't know how much
or more, or $1 million or more.
But you don't know how much more.
But we don't see Bill Gates' income in the census or the CPS, even if he was one of the people who was in the 5% sample. So for that reason, we are. That's the reason why the labor literature hasn't focused as much on those people. The recent research that I'll talk about in a second by Thomas Piketty and Emmanuel Saez uses IRS data to look at some of the trends in exactly that part, and that I think is the most important research on this area. But it doesn't have the same sort of richness as the current population survey or census data. So it's harder to know who exactly these people are, what their level of education is, what industry they're working on, and so on.
Okay, so carry on.
So therefore,
talk about top inequality. Then, what's driving it? That's
right. So therefore, I think that one important point is that we have to distinguish between inequality and top inequality. It might well be that it's exactly the same factors that cause the rise in inequality that are also at the root of the spectacular increase in top inequality. But there are reasons for thinking that that's not the case. I mean, so let me be a little more explicit about it. I mean, we've had a fairly large increase in overall inequality in the United States. If you look at what's going on with the college premium, if you look at what's going on with the things that I've mentioned, like the ratio of the 90th to the 50th or the 90th to the 10th percentile of the earnings distribution or the hourly wage distribution, but we're talking still, things that are not out of all historical precedents. So, certainly we are more unequal now than any time before, any time since World War II. But the levels of inequality that we're seeing in the labor market, are certainly not comparable to what's going on in labor markets in Latin America or even our best data would suggest that these are not out of line with things that U.S. experienced in the early 20th century. So, for instance, just to give you an idea, if you look at the gap between the 90th percentile and the 10th percentile, that has really very, very sharply increased in the 1980s, and sort of stabilized a little bit later in the 1990s, increased again in the late 1990s, and so on. But it's again, as I said, it's in line with historical. It's not out of line with the historical trends if you look at the entire 20th century. What's going on with the top inequality is rather remarkable, and I think we probably haven't seen anything to this extent because of exactly the composition of who is in the top inequality and the extent of the increase in the top inequality. So, for instance, Piketty and Saez data from the IRS. So that's sort of likely to be fairly accurate, as well as reporting to the IRS is accurate. Obviously, one could
I like the word.
one could worry about certain things there.
Like fairly.
But sorry,
I like the word fairly. Yeah.
Yes.
It's somewhat accurate. There's some information there for sure.
So in the 1970s, the top 1% of the earners in the United States captured about 10% of all national income in the United States. In the late 2000s, that number rises to almost 25%. So close to 25%. So that's a kind of a remarkable number, that 1% of the population is capturing almost a quarter of all national income. Now, again, if you go back to the Gilded Age, you'll see numbers that are not dissimilar to this. Again, we have much less reliable data. But what's remarkable is the other fact that Piketty and Saez document about these people is that these, the top 1% used to be rentiers. They used to have their money from capital. So they used to own buildings and
flip coupons, they have bonds and
yes, bonds, and it probably inherited from their family and expanded that money, and so on. And now, over time, these mega earners have become much more like you and I, W-2 earners. So that's kind of the remarkable thing here, which is sort of unprecedented, and I think it's difficult to think how. Sure, for Michael Jordan, we can see what the skills that were so unique about him that made him such a superstar, and of course, everybody wanting to pay tons of money to watch him.
And the technology that made it possible for him to.
And the technology that made it possible that we can kind of broadcast it all over the world, and millions around the world can watch him play. And
so his shoe contract is worth more. And
right. Yeah, so that's certainly undoubtedly part of it, but I think it's also difficult to think that this is just an increase in the demand for skills, and that there must be other organizational changes in society and how we organize different industries and how we incentivize people that have also changed. And I'm not saying that, they have changed for the better or for the worse, but obviously the way that we kind of treat the CEOs have changed over the last 30 years, and certainly how we provide incentives to people who are in top management or in important positions in, for example, the financial industry have changed. And options and bonuses is one part of it, but I think it's a general sea change, and this is where I kind of hinted at some other research that was sort of relevant for this. Is this interesting work by Thomas Philippon at the New York University and Ariel Reshev, and what they show is that during precisely this period, starting from the 1970s, there is just a remarkable explosion in the wages in the financial sector relative to the rest of the economy. So all of those sort of are kind of suggesting that by all means, finance is not the only sector where there is kind of there is a concentration of high earners, but finance is playing a disproportionate role in the top 1%, and the top 1% are not the same kind of people who were the top 1% in the 1960s or 1970s, but they're much more people who are kind of being remunerated for the work that they're doing in either finance or in other kind of high-pay industries of the United States.
So this is an empirical question, obviously, and it's not easy to get an answer to. We do know that the profitability of the financial sector was extremely high in the 80s, 90s, and noughts. We know that's true. We can probably get some pretty good evidence about actual numbers, right? Because we have a lot of these firms are publicly traded. Mm-hmm. We have some idea of what to me is the most chilling part of the financial sector's success, besides the fact that I don't think it was very productive, and I think there are reasons for that. But the other chilling part is the sheer number of people other than the CEO who made enormous sums of money.
Right. Exactly. Yes.
So,
yes,
and we can count. We can get an idea roughly. I don't know if anyone's done it, but you could probably get a count.
Yes.
And I want to stress, I'm not against people making lots of money. I'm against people making lots of money for unproducted reasons using my money without my consent.
Right. No, absolutely. I mean, I think that's another dimension of the discussion that needs to be had more generally. Is do we feel do we feel that, and here feel is the right word because we just don't have the empirical evidence to back this up, but do we feel based on the empirical facts that we have and the theories that we have that a software entrepreneur who has invented a new product that's being used all around the world and is making $1 billion is contributing the same amount as somebody who made some great trades on on some derivatives and is getting $1 billion of bonus.
Well, the
so
standard
you have to make some social. You might want to kind of think about what is the society getting from these two people that are getting the same type of reward from the society.
Yeah, the standard argument, which I'm unpersuaded by, but it's tempting, and I used to make it myself, I'm ashamed to say, the standard argument is, well, the people on Wall Street, they're allocating capital, and allocating capital through these kind of trades and arbitrage and efficiencies, I mean, this is hugely valuable. It's true you can't see it directly, but nothing's more important for capitalism than allocating capital. The problem with that argument is that when you allocate trillions of dollars towards housing, you've clearly made a horrible blunder that we got some benefit from it. Most of it was very small relative to the costs, and I believe that was not a natural market process. It was a destructive one engendered by bad policy.
Right. So, I think it's exactly what you're saying in the big picture, which is that I think it's very difficult to know, and there are different types of arguments. I think this is an area that would really require some very creative new research strategies, because it's very difficult to measure the social value of any activity because most of it gets realized in very complex ways. But I actually believe that allocating capital is a very, very important thing. And if anybody was playing a role in making sure that capital allocation took the right form, that would have a very high social reward.
No doubt.
Now, the question that is in my mind, and I will not pretend to know the answer, is whether when you are making money on short-term price fluctuations, that whether that actually is essential for getting the long-run prices that are more important for the allocation of the trillions of dollars, whether it helps us get those prices right.
Well, I think it would. In other words, I think it'd be important if the prices were right. The question is whether they were induced to be drastically wrong.
No. So that's exactly the point. The point is that we like people who do arbitrage to some degree because they try to they help prevent prices being out of whack. But what the prices that we really worry about being out of whack are the long run prices, not the short run prices. So if IBM stock trades for 3 hours 10% more than it should, that probably doesn't create a disaster for the U.S. economy. Now, I'm not saying this is true, but one line of reasoning. Yeah. But you can make millions of dollars from that 3 hours of mispricing. And that, I guess, is the question, is how much of the money that investment banks are making is due to short-run fluctuations in price that don't really have all that much to do with the long-run allocation of capital. Well, and then, of course, there is the question that you've kind of posed, which is that then this whole process, and through a variety of political channels that it interacts with, might also help get the prices wrong rather than right. For example, the prices of housing, as we've kind of already been hinting about.
Well, let me suggest a different empirical way to think about this and get your reaction. In the venture capital world, which is centered around a handful of places in the United States, but I'm going to put it, it's in Texas, it's in Massachusetts, it's in California, but a lot of it's in California. So let's think of it as California. And we have Wall Street, which is mostly in Wall Street, mostly in New York, although there's some in London and other places around the world. But let's contrast New York investment banking with California venture capital investing. If you're a venture capitalist, you have a fund, you make some bets. By definition, it's hard to do. We understand this. Maybe 3 out of 10 go broke. 4 or 5 out of 10 are mediocre, and there's 2 or 3 that make you wealthy, and if those two or three are successful enough, it makes up for the losses and the mediocrity. Mm-hmm. If you consistently pick badly, either by bad luck or stupidity, you end up with no money, and you don't get to allocate capital anymore from the people, either your own money or from people who trusted you with it. And similarly, if you come up with a good idea, it might not work out. Things go wrong. But it's well known in California that failures get a second chance often if their second idea is really good or if they showed fortitude or other sets of skills. But eventually, if you continually start companies that fail with other people's money, you go out of business and you lose, and you have to go find a productive way to be to feed your family. Right. But on Wall Street, what has happened in the last 25 years is that if you do really stupid things and you lose a lot of money for your firm, you keep going. You make a lot of money. You don't make as much as if you made all good decisions, but you make an immense amount of money, hundreds of millions of dollars sometimes. And as an individual, hundreds of millions of dollars, even though you destroyed your company, and you can stay in the game. So something is drastically wrong. And you're doing it not with your own money, but with other people's money. You know, the question would be, well, why would people continue to give them money? Just like you could ask a venture capitalist who continually funds losers, well, after a while, he doesn't get any money to spend. But in Wall Street, you can keep getting money for a while from you and me, other special. The Fed helps you out. It's clearly inefficient. It's disastrously inefficient.
Well, I think I don't know enough about the career paths of traders and high level finance executives. But I think from what I've read and what I understand is, of course, if you are successful, you get much bigger bonuses, and if you're not successful, yes, you lose your job. And I think it's not as if you make millions of dollars if you are consistently unsuccessful. But I think the problem, in some sense, is that in such a risk-taking environment, even if the story was much less bad than what you just put, which is that I get a cut of the enormous profits I make if I make profits, and if I don't make profits, then I go home with my salary, or I take another job with a reasonable salary. So I make the sort of money that an engineer would do in a respectable company. That already creates terrible incentives. Because you don't bear the downside of the losses, and you can make humongous amounts of money by being successful in the risks that you take. So it's perhaps may not be as bad as what you just said, but it's still, the incentives are just awful.
And you're talking about, the traders. That's an interesting subcategory of folks who I'm thinking about. Yeah. I'm really thinking about the executives.
Right. Some of the executives are because they have golden parachutes and they can go and run another company if they're not so successful. And because their success is hard to judge because it's such a complex job,
correct.
I think the issues are even more problematic in that respect, as you said. Yes.
I think it's a very interesting empirical issue, and I know Bebchuk and I think it's Span have done some nice work on this, showing how much the folks gained even when their firms did badly.
Right, exactly.
And we could actually get, I think this is for those out there listening who are graduate students, this is an interesting case study opportunity to gather some information about the magnitudes of these things. But let's go on. So part of it's an empirical question about magnitudes.
I think that's very important. Let me kind of underscore that. I think there are a lot of things that we're all talking about. There's a large number of economists here talking about these issues, but we have to kind of extrapolate on the basis of limited data. And I think economists generally look down upon just data collection, but I think if you think of Piketty and Saez's work, which was mostly a data collection and data analysis, and it's been amazingly useful, amazingly socially valuable, and provocative, and I think there is really finding good data sources to answer kind of really important questions is one of the things that people can do very, very productively, I think, and there are a lot of open questions there.
Again, I think just the back of the envelope calculation, we have a pretty good idea. We have a very good idea about salaries in the major professional sports. a pretty good idea about movie salaries, actors, how much they make roughly at the highest level. We have a very good set of information about CEOs and executives of publicly traded companies. We don't have very good information about law people in high-profile partnerships. That would be an area where something like the tobacco settlement that enriched a very small number of people an immense amount is harder to get at. But some of that might be public too. I don't know. So there's a digging and compiling project there for a creative person.
Absolutely, that's absolutely.
So carry on. So taking this slightly more depressing path towards top inequality so the
more depressing path towards top inequality. So then let's cut to the chase, since we don't want this to go on forever. So that's the more depressing. So the Rajans story is fairly depressing, but in the Rajans story, political responses just are responses, and that's it. So the more depressing one is that there was a political process that led to certain types of distortions in the financial industry. And those distortions then both laid the seeds of the financial crisis because they encouraged the wrong type of risk-taking, and also in the process made a lot of money for those people taking risks while those risks were still hadn't turned south yet. So that's the story in a nutshell. It's a very simple story, and I think it's, as I said, many people have sort of written about it. And
so talk about in your presentation, you talked about the political science literature that correlates, unfortunately, giving to politicians, contributions to politicians with policy outcomes that benefited, say, the housing industry.
Right. So if you kind of compare Raghu Rajan's hypothesis to the alternative hypothesis that I just laid out, politics is very important in both of them. And I think, again, Raghu deserves a lot of credit for kind of putting a bunch of really important, interesting ideas on the table. But politics plays out very differently in the two stories. In the Rajan story, the political responses come because politicians are somehow responding to the discontent of the bottom of the distribution. Or in response to my comments, Raghu said, well, perhaps it's not the bottom, but it's the middle of the distribution. Whereas in the story that I suggested, politics is playing out by responding to lobbying, campaign contributions, and in otherwise the ability of the already well-off and already well-organized to influence and guide the political process.
So it's not technological change; it's institutional change.
It's not technological change. It's the good old technology that people have known for centuries. Money begets you power. I cited from Marcana.
Marcana, the 19th century, right?
19th century, yes. He was McKinley's campaign manager, and he said there are two things that matter in politics. The first is money, and I can't remember the second. So it's the same thing. It's just we're now 100 years since then. So essentially, political scientists have done a bunch of work on this, and there are lots of descriptive statistics. I must caveat that, here we have some data, but the data again are not ideal. So much more data is needed, and also the empirical work here is not the kind of well identified. We definitely know the causality. But it's very interesting correlation. So Larry Bartels and a bunch of other political scientists essentially took data on how senators or other politicians vote and looked at how their votes correlate with the opinions of their constituents from a number of surveys on exactly the same issue. So you can do this issue by issue, or you can do this overall, are they voting more to the right, more to the left? And you sort of get the same picture independent of how you do it, that again, at a correlational level, regardless of whether you look at economic issues such as budget waiver, minimum wage, budget rules, or you look at social issues such as, civil rights, abortion, and so on, the way that senators vote is very highly correlated with what their high-income constituencies think. It's moderately correlated with what their middle-income constituents think, where high income is top one-third, middle income is second one-third, and low income is the bottom one-third. It's absolutely not correlated with what the low income want. So on the basis of this, it's very difficult to see sort of how it is that, American politicians are responding to what their low-income constituents want. Okay, if you say it's not low income, it's middle income. Even for a middle income, they are correlated with the middle income, but they're much less correlated with the middle income than they are correlated with the high income. So it's really
it's not so surprising.
Sorry?
It's not so surprising.
So I don't think
it's pretty plausible.
I don't think it's surprising, and I think that's the reason for that is exactly the second piece of evidence that political scientists have, which is that this is part of it is just data, which is that there has been an explosion in political action committees and campaign financing and lobbying expenditures, both for the Congress and the federal branch, over the last 35 years, and the press is full of anecdotal evidence that both parties, politicians of both parties, have really had to change their positions because of their concerns about fundraising. So when you take that into account, I think there's a good channel for why politicians are going to be more correlated with their high-income constituents, because they want the money of the high-income constituents.
Sure. I think it's true. Now, the question is, what limits that desire to make the people who give you money happy? And the answer is there's political. Although it's true that poor people can't donate much money, they vote. Now they vote at lower rates than high educated people, for example, and I assume for higher income people in general. But they still vote, and by definition, there's a lot of people below the median, about half of them. So it's they're not irrelevant. So
no, absolutely, they're not irrelevant. So let me come to that. But I think before we come to that, let's take stock. I mean, I think if we're going to look at these two hypotheses of how politics matters, I think at face value, it's much less likely that the political system was responding to the discontent and the angst of the bottom, especially in the 80s and the 1990s, than what the top of the distribution wanted. So I think a story that works through lobbying and campaign contributions, and not only lobbying and campaign contributions, but just access to politicians and thus being able to, it's not just, that you're buying the politicians. I think you're also influencing the politicians. And the best way of influencing the politicians is to talk to them. And having access, which is also, again, something that requires money, is very important in this process.
I agree.
So what limits that? I think in general there are several things that limit it. First, I think the decency of politicians is limited.
Shame matters.
I think I'm not going to say that all politicians lack decency. Some of them do, some of them don't.
Fair enough.
But I think we don't want to. In economics, I think we are good at one thing. We don't just want to rely on the decency of people. We don't want to deny the decency of people, or we definitely don't want to condone indecent behavior. But we want to make sure that the incentives are right so that we don't have to rely on heroes. So you don't want to rely on the decency of the politicians, and especially given the track record of some. But second thing that limits that is political competition. If one party is veering to a particular position, then the other party can take a different position that's more attractive to the voters and deal and try to kind of get more votes. And I think that's where Larry Bartels, in his book Unequal Democracy, sort of, and also a couple of other political scientists like Hacker and Pearson make in the book Winner Take All Politics, make the following argument, which I'm not sure how true. I mean, I don't think they back it up, but I think it's an interesting argument, that essentially what this sort of campaign finance pressure has really been quite decisive for Democrats. So Democrats who were supposed to take the opposite position to Republicans on some issues, they sort of felt this campaign pressure and they didn't take those positions. And I don't know how convincing this story is, but I think it may or may not be one reason why the political competition channel for checking this influence, the influence of money in politics, may not have worked as well as it should have.
Well, let me give you three issues where I think in every case there was a failure of political competition, and it's either because it's in the nature of human beings to do what I'm going to suggest, or because there's just less competition and politicians can exploit that in ways that are not good for the rest of us. So for my story, which is not unrelated to yours, I sort of look at a combination of Rajan and your story. So here's three issues. Issue number one, when a large financial institution is about to go bankrupt, what should we do? And the answer since 1984 is almost always let the stockholders lose all their money and let the creditors, the bondholders, and the lenders get all their money back 100 cents on the dollar. That's the decision that we have consistently made. It has been a bipartisan, shockingly to me, a bipartisan consensus that that's always a good idea, lest there be financial instability. So that's case number one.
I agree with that entirely. Yes, that's been a big problem.
Big problem. Case number two. Is it a good idea for the homeownership in the United States to go up? Now, around the mid-'90s, there was a huge push from both Democrats and Republicans, more Democrats, but when the Republicans got more empowered, they pushed it too, that said we should try to increase the homeownership rate. Now, we can argue about Fannie and Freddie you do in your presentation. Let's put that to the side for the moment. What is true is that when this push was made, the homeownership rate in the United States started a steady increase, which in areas that were particularly supply constrained, that it was hard to build new houses, that resulted in large price increases. Who was in favor of that? Well, there were some sinister people in favor of it, or that's not the right word, people who had a self-interest in it. Those were people in the real estate business, people who built houses. It was also people who could profit from that. Those were people on Wall Street who could invent new securities that would allow people to invest in those homes. It was also people who cared about the poor. People who this is the Rajan argument. It was also people, the poor themselves, who hadn't had access to home ownership. People who felt that was unfair, that something unfair was going on, so they supported it. So there was this beautiful consensus across party lines and across interests of different sectors that this was good, basically, that it was cheap. There was no budgetary cost at the time. So those two, I forgot the third one, but those two decisions along, the bailouts. So when we had a choice to funnel money directly into these institutions that had made bad investments, there was, a bipartisan consensus. Not, I'm helping my friends who are rich donors. Not, I'm helping my friends in the financial sector, but this is good for the country. People were able to convince themselves of that. If you want to give it a nice sheen, if you want to give it an ugly color, you can say they were helping their rich friends. But in those three cases, there was no political competition. The only people who voiced dissent from that were people on the fringes of either the parties or outside the party structure who said, these are bad ideas. How could that recipe, those three things, fail to create disaster?
Well, I mean, I don't disagree. I don't disagree with much of what you've said. I mean, I think on the house ownership thing. I agree with you that artificially inflating home ownership rates is, and especially doing it through such things as mortgage tax credit, which I think is just a really bad idea, is a really distortionary form of increasing our taxes because we then give it back in a distortionary form. I think I agree with all of that. But the research that people have done, there's these two interesting papers by Neil Butta, who who is now at the Federal Reserve Board, I believe.
Yep.
He was a graduate student at MIT. So he looks at both the Community Reinvestment Act and the underserved areas goal provision, which is kind of a key part of the
Fannie
GSE.
and Freddie. Yep.
Yeah, the kind of the GSE process that kind of essentially set goals for Fannie and Freddie to purchase a certain amount of mortgages in lower income and minority areas. And what he finds is that those had very small effects.
Yeah, I know. It's two interesting papers. We'll see if they stand up, but they're provocative.
Yeah.
And I agree that I don't think the Community Reinvestment Act was decisive. But we do have this fact. The fact is the rate of home ownership in the United States, which had been stagnant, and this is where I think Rajans' thesis is relatively maybe important in terms of political pressure. Although, again, I think there's an entrepreneurial side from the politicians as well.
Yeah, I think the entrepreneurial side is much more important. So, I mean, the other thing that we didn't talk about that let me just briefly say is that, the timing is also a little strange for the Rajan hypothesis. So, I mean, of course, timing-based arguments are not easy. You can go around them by kind of invoking
lags.
Long and variable lags.
Yeah, lags are always good, yeah. Foresight, if you need to. People anticipated it.
But if you look at the data, the big increase in inequality, and both for the bottom, both between the 90th and the 10th, and between the 90th and the 50th, is actually in the 1980s.
Yeah.
It's certainly not in the late 1990s. Actually, the late 1990s and the 2000s are remarkable because both the bottom and the middle of the income distribution are doing reasonably well. So you need this story that the inequality caused it with a 20-year delay. It couldn't have been the increase in inequality in the 1990s because that was trivial or, in fact, non-existent. It was the increase in inequality in the 80s and early 90s that caused it. So it
just took a while for it to build up.
Yeah. That's the long and variable delay story.
I'm with you on that. I don't think that's important. I totally agree with you.
So then coming back to the checking the behavior of the politicians, I think the other thing is the media. I mean, I think the media is a key factor in making sure that when politicians take positions that are very heavily influenced by a small group or by campaign contributions or by lobbying, that this actually gets sort of enough attention and there is reaction to it. See, the problem is that as you suggested, and as the logic of democratic system is, the way that we correct politicians misbehaving is by voting.
Yep. But
what does the campaign contributions do? Campaign contributions enable the politicians to influence the vote in a very strong way.
Yeah, do we have
it's like a vicious circle.
Yeah. Do we have good evidence on that, by the way?
On what part?
On the power of money to influence elections. Seems logical, right? Obviously, people can buy more ads, and at some level, it's overwhelming, right?
Yes.
And the other point I would mention is that name recognition has benefited incumbents in recent years because of, I think, the lack of competition induced by campaign finance reform. So there is a lot going on there.
So I don't know of any convincing evidence that shows that more money has a causal effect, but it seems like
plausible.
But it seems extremely plausible. We have interesting evidence that having access to different information sources has an effect. So there's this interesting paper by Stefano Della Vigna and Ethan Kaplan on the Fox News effect, kind of exploiting the fact that certain areas got Fox News cabled at different points, and they find not a very, very large, but a sizable effect of having access to Fox News on Republican presidential vote share. There is evidence from David Stromberg and Jim Snyder on how politicians are responding to their media coverage and there's a very interesting paper kind of exploiting the fact that some politicians are in the coverage area of different states, so they don't get covered in the local news, and they behave very differently than politicians who are in the coverage area, and therefore news about them are more easily available to their voters. And then as a graduate student at MIT, Leopoldo Ferguson, who uses the same strategy to look at how much the media counters the effect of lobbies, and he finds some evidence consistent with the fact that there is some interaction between media coverage and politicians who are getting a lot of money, especially a lot of money from some specific political action committees. So there is some evidence building up that these things are important, but not enough at the moment to say exactly how we should design kind of access to information and so on, so to make sure that the democratic process works better.
Yeah, I think again, I think there's a great empirical opportunity here. My simple test for whether money is important is how much time and energy politicians devote to collecting it. They're not
exactly
stupid.
Exactly. So in response to your question,
they're specialists. They know what they're supposed to do.
If it didn't matter, why are they losing their every waking hour on this?
Yeah. So we're almost out of time. Talk about taking either your variation on Rajans' thesis or some combination. What do you think we might do to make this better? In particular,
I think it's very related to this last set of issues we talked about. I think I'm not in favor of very big top-down interventions. I think we have to find ways of encouraging the existing political processes in the United States to work better. So it's about making sure that money politics doesn't become even worse in the United States. Media plays a better role in checking politicians, and I think some form of campaign finance reform would actually help. Even though I said I'm not in favor of big intervention, I don't view that as a big intervention. In fact, we've gone in the other way. I mean, we've gone in the other direction with the recent Citizens Be United case that actually we might have undermined any kind of checks on campaign contributions that we have for politicians. But I think we have to make sure that the different parts of the population are involved in politics and are informed to the best extent that we can, so that the political process, the democratic process, works as healthily as it can.
Yeah, I think again, I'm going to point to an empirical argument. I think transparency is hugely important. It's true that when the media uncovers a scandal or exposes something, it's not sufficient to stop it, but it does. I think it has an effect. Here's an interesting question. During the weeks before the AIG bailout, Hank Paulson, the Secretary of the Treasury, talked to his successor at Goldman Sachs, Lloyd Blankfein, I think 2 or 3 dozen times. Now, I'd love to know what they talked about. I have a feeling, my joke is, I probably made it on the program before, I apologize to my listeners, but I don't think they were talking about their kids' summer vacations and what was going on, right? So one just trivial idea. Wouldn't it be interesting to know about who walks into a politician's office and who they talk to on the phone and for how long? You'd think that could be publicly available. It's not, of course, but you think requiring that would be a healthy thing. And, I just have to wonder, as you point out, access is so important. Why is it that in a world of campaign finance reform, the CEO of Goldman Sachs or Bear Stearns or Bank of America or Merrill Lynch, their ability to donate directly to a politician is extremely small. Why are they so popular? And one answer is they, of course, can direct the contributions of their employees. But it's an interesting question of what's actually happening on the ground. It would be great to get an expose written by an anonymous staffer about.
Right. That's a very interesting idea. I mean, I think in many of these cases, we are talking about the influence that comes not only with money, but it comes with expertise. So it's another aspect of the problem. But Wall Street has the monopoly on expertise. Perhaps even it has more of a monopoly that its own true expertise justifies on financial matters. So when Hank Paulson wants to get an idea about what's going to happen to the financial system, he calls Lloyd Blankfein or Jamie Dimon, and so. But what he's getting, of course, is not the objective truth, but truth either filtered through their perspective or truth somehow shaved through on the side so that it actually fits the interests of their company. Yeah. So I think that's actually a very important part of the influence process. It's not directly lobbying, but it's the related thing that who has access is determined by who is the expert, and the experts are of course the rich and powerful and the interested parties, and the policymakers are just listening to these experts, especially during critical periods.
Yeah, the cheerful version of this, of course, is that the glass is half full. Just think how few people are able to exploit that connection, right? The average American, and even many people, as you point out, who are CEOs in many industries, actually have to make a living and can't steer things and have any input like that. So maybe we should be grateful it's only the financial sector that's got this power.
Right, that's the other. I mean, I actually totally agree with that. I mean, I think there are really important issues here to watch out for, and I think the U.S. political system has shown, to use Raghu's term, fault lines of its own in this process. But on the whole, I'm still an optimist that U.S. still has some of the strongest institutions in the world, and so far, the extent of overt corruption has been limited. Politicians, there has been a revolving door policy, especially in the lobbying side, that I find very, very distasteful. But few politicians have used their power to enrich themselves. And I was also pleasantly surprised by, for example, the way that the several commissions recently have come up with sensible proposals about how to tackle the budget deficits and so on. Of course, it didn't receive overwhelming support from the Obama administration, and it didn't receive bipartisan support and so on. But still, the political system is not stuck, and it's not in the pocket of just one group or another. And I think I'm an optimist that we'll come out of this and with a few scars rather than all of our limbs broken.
My guest today has been Daron Acemoglu. Daron, thanks for being part of Econ Talk.
Thank you very much.
This is Econ Talk, part of the Library of Economics and Liberty. For more Econ Talk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for Econ Talk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.